Okay, let's do it. So I'm going to give you each 5 minutes. I'm going to give you a 1 minute signal. Once 1 minute left. And I'm going to, once the alarm goes off, I basically want you to wrap it up. So kind of think about that. 15 seconds. State your final point. We have 13 left to go. We need to bang out at least six today so we can get them all done tomorrow.
Okay. All right, class. I'll be presenting to you today Alibaba and why I think it's a buy. So Alibaba incorporates a lot of smaller companies. They own Taobao, Alibaba Cloud, Ant Group. You might be familiar with that. It's been in the news recently. And some other companies like AliExpress. They primarily engage in providing online and mobile marketplaces in retail and wholesale trade. AliExpress is more of their wholesale website. Their retail website, that would be more like Alibaba and Taobao. A lot of people in China, I think I read a statistic like 93% of online shoppers actually use Taobao, and it has a really high user retention ratio of around 97%. So that's actually really good. And in terms of monthly active users, Taobao is on the rise, and that's not slowing down anytime soon. Their market cap, when I made this slide, was at 350 billion. They were trading at a PE ratio of 18.81, and their 52-week low, that's actually outdated. Friday, the stock hit a 52-week low of around $110. So if you can believe that, on Friday, we went from 126 to 110. Here's my cap table. I have Alibaba priced at a buy price of $188 per share. I had told you, Mr. Carr, and I arrived at that buy price by looking at what the fair value was according to Morningstar, but I went back and revised that, and I have that in a later slide. And a no-brainer price, I just used the 5-star morning price for that one. You can see there my revenues, but I want you to pay close attention to the year 2017. If I go to the stock chart, you can see that the stock is currently trading at levels not seen since 2017, but check out that income statement. Back in 2017, they were doing $23 billion in revenue. Right now, they're currently doing $105 billion of revenue. So, that's insane. The fact that you can buy this company today at the same price that you could back in 2017, I think that's an interesting opportunity. So in the past year, Alibaba went from 317 per share to $122 per share. This is mainly due to a slowdown in the Chinese economy and a regulatory crackdown on big tech firms by the CCP, Chinese Communist Party of China. Some people think that the stock could still face a possible delisting as geopolitical tensions between the US and China continue to mount. In my opinion, I think these fears are overblown. I believe this stock is currently trading at a significant discount. I have 3 thesis points, one focusing on valuation, one on fundamental, and another one more on macroeconomic perspectives. And the way I see it from a valuation standpoint, Baba stock is trading at a 4-year low and an all-time low in the context of its rolling next 12 months PE ratio. So buyers of the stock today will benefit from a comfortable purchase price against the next 12 months. Baba's core commerce business is very profitable with over 30% adjusted EBITDA margins. Baba also has a strong history of beating earnings. It's expected to grow earnings well into the foreseeable future. And one thing that I think that investors are not really taking into account is that China's interest rates are currently hovering around 4 to 5%. I think that if the economy were to slow down, they can easily lower rates and print more money to support the economy. Whereas the Federal Reserve already used up all of its ammunition in that area, so China can still adjust its policies in the near-term future. And there are several risks associated with investing in Alibaba. One of the risks that I mentioned already was the delisting risk. So Alibaba investors have no margin of safety. It's advisable for investors looking to purchase shares in Baba to buy the Hong Kong listed shares instead, and those trade under the ticker symbol 9988. There are new CCP regulations that could stifle the growth of Alibaba. There's been fines, and additionally, the CCP has also taxed them. And there's also been macro weakness in China as a result of China's highly levered property market. Here's the valuation chart of Alibaba. You can see the PE is sort of at an all-time low. Here's my R&R spreadsheet. So we're looking at a return of around 60%, and your downside risk is 30%. So that's pretty good. Asymmetric odds. This is a summary of Alibaba's most recent quarter. They didn't report too hot. Their only revenue segment that grew substantially was their cloud computing segment, and currently their only profitable revenue segment is their core commerce. Everything else is unprofitable, but I do think that's going to change in the future. Really interesting. If you follow Bridgewater, they increased their position by over 131% over the past month. So, Bridgewater is very respectable, and that's notable. And this is the VIE structure for BABA stock. This is why I recommend that you purchase the Hong Kong listed shares, because this VIE structure is sort of shady. It's called variable interest entity, and they set up like this shell corporation in the Cayman Islands to essentially give investors the opportunity to invest in the company, but they don't actually own any voting rights. And in the event of a delisting, you get liquidated. I put in this article from last week. Didi got delisted from the stock exchange, and Alibaba, that's why it tanked to 11% last week. And here's my estimate upside based on this DCF tool that I used. We're looking at around 58% upside, assuming a terminal growth rate of 4% and a growth rate for the next 10 years of 20%. Any questions?
So we'll do 2.5 minutes of questions. So what happens if you walk me through what happens if it gets delisted? So if I buy the stock at 120 and it gets delisted, what happens to they?
Well, same thing that's going to happen that happened to Didi on Friday. I think the stock price is initially going to just sell off really badly. Eventually, buyers will start to come in, and their shares will get transferred over to the Hong Kong listed shares. So the way they're doing it on Didi is they're going to have the stock IPO in Hong Kong, and they're going to do a seamless integration from BABA shares to Didi. So, question? Yeah, so quarter three was not so stellar. Yeah, and that's part of the reason for the big drop as well. And it's not that their earnings were terrible, it's that they just slightly missed growth expectations. But that's the thing about buying a company when expectations are extremely high. If they even slightly miss or just report in line with what expectations are, the stock is going to tank, and that's exactly what it did. So, question?
The Chinese government, they're at odds with the CEO of Alibaba, correct?
Yeah, they are. So recently, Alibaba CEO went into hiding, Jack Ma. So he became a big figure, and a lot of people in China were admiring him. And you still got to remember that CCP is very communist. So they have communist ideas, and Jack Ma is a flaming capitalist. I think that they wanted to sort of make an example out of him and remind the people who's really in charge. So they're basically saying, the CCP is in charge. We get to decide who makes money in this economy, how they make it. And I think it's more of a power statement from the CCP, all that harassment that they did to Jack Ma. So yeah, unfortunate that happened to him, but it's China's loss. I think that entrepreneurs in the future will likely come to the United States. I don't see why anybody would want to start like the next Google in China after something like that, but I don't know. Any other questions?
One more question.
Yeah. I don't think so, because I think that China would be all over that. I think that what's happening in China right now is a nationalization of their most valuable assets, and they've identified their tech firms like as their most valuable nationalized interest assets. So they don't want to share their tech companies with us. They don't want their investors, like foreign investors, to own those companies. They've made that very clear. They make it difficult for foreign investors to even own real estate over there, right? So they're locking down all their foreign interests. I really don't think that the CCP would allow China, Alibaba, one of their most strong and important companies, to just walk out of China like that without any negative implications. And plus, most of their users are in China. So if they want to do China, business in China, they're going to have to abide by the CCP's rules. Yeah. All right.
All right, who's the next lucky soul?